Hey everyone, welcome to this explainer. Listen, if you're a contractor, a small business owner, or an operator who has just gone through a consumer proposal or a bankruptcy, I want you to just take a breath for a second. Going through that, it often feels like the absolute end of the road. It feels incredibly heavy, stressful, and sometimes deeply personal. But the reality is completely different. Completing a bankruptcy or a proposal isn't the end of your business journey. It's actually the beginning of a well-deserved financial fresh start. Today, we're going to look at exactly how you make that comeback, specifically when it comes to financing the heavy equipment you need to get back to work. Okay, let's dive into this. The biggest question on everyone's mind is always this: can you actually finance heavy equipment in Canada after a major credit event like a consumer proposal or a bankruptcy? The answer is a resounding yes. But, and this is a massive but, the playbook is completely different. You absolutely cannot approach this the way a prime credit borrower would, and expecting to do so is only going to lead to frustration. So here's our roadmap for this explainer. 1. The reality of business debt. 2. Your financial fresh start. 3. The 3 lending tiers. 4. Financing with bad credit. And 5. Blueprint for deal approval. Let's get right into it.
All right, Section 1, the reality of business debt.
To figure out how to rebuild, we first need to look at how the law actually views your debt. Now, for a lot of contractors, the lines between personal and business finances get kind of blurry, right? But legally, that distinction is absolutely crucial. If you're a sole proprietor, there is zero legal separation between you and your business. Your business debts? Yeah, they're literally your personal debts, which means creditors can go after your personal assets. This is exactly why your personal credit is the absolute lifeline of your business. On the flip side, if a corporation fails, it's a separate legal entity. Unless there are personal guarantees or specific statutory debts, like payroll tax, the individual isn't automatically bankrupt. But for a sole proprietor, a business failure and a personal bankruptcy are essentially the exact same thing.
But here's the thing. Going through bankruptcy doesn't mean you just lose your ability to earn a living. No way. While your assets generally vest in a trustee during bankruptcy, provincial laws actually have specific exemptions built in to protect you. Take British Columbia, for example. Under their asset exemptions, you can keep up to $10,000 worth of tools of the trade. That's the essential gear you literally need to work. You can also keep up to $5,000 in equity in a motor vehicle, basic household furnishings, and your RRSPs. The whole system is designed to give you a fresh start, not to totally strip away your ability to generate an income.
Moving right along, Section 2, your financial fresh start. Now, what's really interesting about this next part is that once that heavy legal burden of insolvency is finally lifted, you actually enter this really active, empowering phase. Rebuilding credit after a bankruptcy, man, it often feels like staring up at this totally insurmountable mountain peak. It's incredibly daunting, but you don't have to leap to the very top all at once. Actually, scratch that. You can't leap to the top. Rebuilding credit is a step-by-step climb. You just take a few careful, deliberate steps every single day, and eventually you hit that summit. So, what exactly do those first steps look like? Well, step 1 is to get your credit reports from Equifax and TransUnion. You've got to make sure everything is accurate and that your discharge debts correctly show an R9 rating. Any errors here will absolutely drag you down, so you want to fix those immediately. Step 2 is setting your goals. Are you trying to buy a house, a new work truck, maybe some heavy machinery? Knowing your destination dictates your entire strategy. And then, step 3 is picking your path. The safest way to start rebuilding that credit history are using secured credit cards, where you put down a physical deposit, or taking out fixed installment loans where you can't just reaccess the money you've already paid down. But as you start this climb, I really want you to remember this quote: "Just in case is the most dangerous phrase in credit." Keeping a credit card around just in case is a huge trap. It mentally detaches you from your purchases, right? It makes it way too easy to justify a little expense here, another one there, and before you know it, you're sliding right back into that exact same cycle of debt that caused the insolvency in the first place. Rebuilding takes real, strict discipline.
Which brings us to Section 3, the 3 lending tiers.
Okay, so when you're finally ready to finance equipment again, you really need to understand how the Canadian lending landscape is actually structured. It's not just the bank versus everyone else. It's like a giant puzzle divided into 3 distinct tiers. Tier 1, that's prime. We're talking traditional banks and credit unions. They give you the lowest rates for sure, but they demand excellent credit, usually a score of 680 or higher, and they take weeks to process a file. Tier 2 is intermediate. These are non-bank lenders for folks in that 620 to 679 score range.
They're a bit faster, a bit more flexible, but if you have a recent bankruptcy, you are looking squarely at Tier 3, non-prime or alternative lenders. These guys cater to scores below 619, startups, and those with bad credit. They move incredibly fast. I mean, we're talking 24 to 48 hours, but you typically have to access them through specialized brokers. And it's so vital to understand the psychological shift between Tier 1 and Tier 3. See, traditional banks absolutely hate what we call stacked risk. If you bring them a file with specialized equipment, challenged credit, and seasonal cash flow, they will flat out reject it. It just doesn't fit their rigid little boxes. Private alternative lenders, though, operate totally differently. They don't simply reject risk. They price it. They'll look at your complex file and say, okay, we can do this, but they'll adjust the interest rate, maybe shorten the term, or require a higher down payment to get the deal funded. They basically turn a hard no into a yes at a premium.
All right, Section 4, financing with bad credit.
Let's make this super tangible and look at exactly what it takes to secure heavy machinery. And we'll use the highly specialized, rugged Canadian logging industry as our real-world example here. So the crucial point is that alternative lenders evaluate your file holistically. They look way past that 3-digit credit score. First, they look at your secured debt history. Did you always make your truck or equipment payments, even if some old credit card went to collections? That carries massive weight. Second, they want to see signed cutting contracts or timber allocations. This proves you actually have guaranteed revenue coming in. Third, they need to see 6 to 12 months of clean bank statements to really document that cash flow. And finally, they look at the source of your down payment. They want to see seasoned cash just sitting in your operating account, not money you borrowed from your buddy last week.
And speaking of that down payment, you've got to be prepared for this. For bad credit files on highly specialized machinery like feller bunchers or skidders, alternative lenders are typically going to require a down payment of 25 to 33%. Yeah, it's a significant chunk of change, I know, but that is exactly what mitigates their risk and gets your file approved.
Now, I get it. When you hear about high down payments and interest rates jumping into the mid-teens or even higher, it is super easy to get sticker shock, but you really have to shift your perspective on this. The cost of not having the working machine is usually way larger than the interest premium. Think about it. If you miss an entire winter cutting season or you lose a really lucrative contract because you just don't have the gear, the damage to your bottom line is far worse than paying a 14 to 18% interest rate for a couple of years while you rebuild your credit.
Let's look at a concrete example to really prove this math. Imagine you need a used Tiger Cat 635E grapple skidder. Let's say the purchase price is $180,000. Because of a past bankruptcy, the lender requires 25% down, so that's $45,000 out of pocket. You finance the remaining $135,000 at a non-prime rate of, say, 14% over 48 months. That brings your monthly payment to roughly $3,688. Now, to put that into perspective, if that machine generates $40,000 to $60,000 a month in gross revenue under your signed contract, that $3,688 payment is an absolutely brilliant, highly profitable business move. The math just works perfectly.
And finally, Section 5, blueprint for deal approval.
So you understand the math, you understand the landscape. Now let's map out the exact strategic action plan to get your next deal across the finish line. First things first, always lead with a signed contract. It instantly answers the underwriter's biggest worry, which is, how are they going to pay us back? Second, write a 1-page, purely factual explanation of your past insolvency. Look, don't make excuses, just explain what happened and how you've recovered. Actual humans underwrite these files, and context matters immensely to them. Third, clear up any tiny collections. Got an old $600 cell phone bill? Pay it before you apply. That alone can instantly boost your score by 20 to 40 points. And finally, tie to target machines with a broader resale market. For example, a skidder is much easier to finance than a highly specialized processor, simply because if things go wrong, the lender knows they can easily resell that skidder.
And this brilliantly illustrates perhaps our most important warning today. Do not shotgun your applications. Sending applications to literally every bank and lender you can find on Google is going to result in multiple hard credit pulls. This will severely damage a credit score that's already challenged. Instead, you want to use an independent, specialized equipment finance broker. A good broker understands your industry, knows exactly which lenders have an appetite for your specific file, and can shop your deal to dozens of lenders using only a single credit pull. They are literally your absolute best asset in this game.
Wow, we've covered a lot of ground today, haven't we? From navigating the tough legal realities of business debt all the way to mapping out a strategic comeback with alternative lenders. The path from a consumer proposal or bankruptcy back to business growth, it isn't some huge mystery. It is completely mapped out, mathematically proven, and waiting for you to take that very first step. So I'll leave you with this question. Are you ready to take control, rebuild, and turn your financial fresh start into your next big contract? Thanks so much for joining me on this explainer, and I'll see you next time.